All right, welcome back. Ed Ponsi here on behalf of FX Street. Thanks for coming back. And it's the second session of the day on June 8th, 2017. And just going to the 5-minute here on the euro. We pretty much everything that we covered during the first session at the end. There's really no need to rehash it. If you missed it, go to the first session in the archives. There's really not much else to say. You're going to see zero interest rates probably for years in the Eurozone. You're going to see at least another year of quantitative easing. And you see that big red candle there on the 5-minute? Draghi reduced inflation expectations. So that's pretty much it. It's not a lot. On a 5-minute chart, you see a lot of big wicks, and it looks like a lot of volatility, but in the big scheme of things, it's really not that big of a move. It ends up being not that exciting of a day compared to some of the other fireworks that we've seen on ECB days and on Draghi speeches. This isn't really that big of a deal, right? We've seen some much more exciting results. Okay, so we're going to let that go. And we go to the daily chart. So I don't think we're going to get down to 111 based on Draghi, but we might get down to 111 based on Kami's testimony. That starts in less than an hour. Of course, that could move the dollar. So if the dollar strengthens, you could see 111. I think 111 is a buying opportunity on Euro USD. So if Kami's speech has nothing waiting for Trump, you could see the dollar get stronger. The dollar getting stronger would cause the euro to get weaker, and that could push euro to 111. Kami released some of his prepared remarks last night, and there didn't really seem to be anything incriminating in there. It sure seems like, but like there was nothing in there to indicate that Trump was under any investigation. Of course, that could change today. You never know. We all know that you can't predict what's going to happen. So you don't want to get too far out ahead and try to predict anything. So anyway, that starts at the top of the hour. So 10 o'clock New York time. Right now it's a little bit after 9 a.m. New York time. And then you're going to have the polls closing a few hours after that in the UK. The pound has been pretty resilient. It's above 129 right now. Looks like the exit polls seem to show a conservative victory. And right now that seems to be something that the pound seems to like that right now. Of course, who knows how the pound will feel about that later. I'll jump right over to Aussie CAD. Look at that. Boom. Looks like Carlos hit a target there. Good job there, buddy. Big green candle. Right? Big green candle there. I was going to say, you've got a speech from the head of Canada's central bank coming up in a little bit. So that may or may not affect your trade. 2 hours and 7 minutes from now. The head of the Bank of Canada, Polo's Bank of Canada governor, is going to be speaking. Maybe it may not be a big deal. I don't know if he's going to be speaking directly about monetary policy, but Aussie is on a roll. You can see, and oil all the way down to 45. Did you see this? Even with Saudi Arabia and Qatar, maybe it's not quite 45. But man, that's a big red candles. Just a sec here. Yeah, not quite 45, but approaching it, right? I see a low for the day of $45.20, and currently at $45.34. So just oil just bleeding as U.S. production continues to increase, picking up the slack for OPEC cutting, and that just continues to wound Canadian dollar. Just, man, look at that big red candle from yesterday on those inventory numbers. Just inventories just keep piling up, and the issue now is that there's so much coming out of the Gulf of Mexico that they don't know where to put it all. Just fantastic. Qatar. The BBC pronounced it Qatar. Okay, thanks. Yeah, I've heard it pronounced gutter, Qatar, Qatar. I've heard it pronounced so many different ways. Anyway, and with these countries right at each other's throats, you would expect oil to move higher, and it's simply not happening. So if they can have a peaceful resolution to this, oil probably goes even lower. Be my point. I think you see 43, right? You see this area down here. I think you could see that over here. Let's say that, these countries decide they can talk it over. I think you go right to 43. Unbelievable, right? I mean, who saw any of this coming? That's the one thing, it seems like I haven't come across anyone who can sort of accurately predict, excuse me, oil and gold. But oil seems to be so unpredictable. The one thing, the term peak oil, people used to throw that term around 5 years ago. All the experts would say peak oil, meaning this is it. The price of oil is just going to go up into infinite. It's just going to continue rising from here because we're just there's a finite amount of oil, and we're just simply going to there's a finite amount, and we found as much as we're going to find, and it's just they were so wrong. They couldn't have been more wrong. Finding more and more of it, and they're getting better and better at extracting it. Okay, so anyway, dollar CAD. We said if it popped up on the 60, I wasn't going to buy it. So if we popped up, I wasn't going to short it. If it shot down below 134, I wanted to buy it. But it didn't shoot down. It popped up, so no trade. This was for yesterday's oil inventory report. So it was no trade. Good thing, too. It shot up quite a bit. Now, if it shoots up, though, and if I had taken it short here, it could still work out. I'm not saying if I had held on to it and been patient, it might still work, but I didn't take the trade. So my plan was, I just didn't like the resistance up here, but I really liked the support down here. And the oil chart seemed to really agree with the dollar Canada chart regarding support. Did not seem to agree too much regarding resistance. So I said, all right, if it comes down, I'll take it. If it goes up, I'm not going to take it. So I did not take it. Excuse me. But however, if this had come up, if I had taken this, it's not necessarily a bad trade. It might have worked out fine. It is coming down now. You'd have to be very patient. I wasn't looking for a overnight trade. I was looking for a very short-term trade, however. So this probably would have been a loss because I was just looking for a quick in and out. But I didn't take it. If this was something I would have taken, though. All right. Back to Aussie CAD, though. Now on the 60-minute, here you go. Now you've hit your target on the 60-minute. It is making a tiny little double top on the 60-minute. That doesn't mean I would bail out if I was long. Right? But assuming that this blue line was a target, you should have closed something out already. Right? You should have taken something off the table already. So the load is lighter. And the one thing I'd say, just real quick aside here, I see your question, I'll get to that in a second. People see this and they'll panic. It's tiny. It's tiny. It's it's a 20 pip formation. If you rode this thing up hundreds of pips, and now it's going to drop 20 pips, and you've already hit one of your targets, it shouldn't be that big of a deal. Using a measuring technique, a 20 pip drop is down to here. If you bought it at this green line and you went all the way from A to B, and now it's going to drop to here, that should not bother you. That should not keep you up at night. Okay, that's just, it's no big deal. Okay, so kudos to Carlos on hitting that target. And I wouldn't be concerned in the least about the double top. There it is on the daily. And inside that daily candle is the hourly double top. Carlos is shooting for target 2 here. And I wouldn't be concerned about this small little red candle either, just because everybody knows they're calling it Super Tuesday out there because there's so much event risk. Like, we get testimony from the former head of the FBI in 45 minutes. And that could rattle the markets. Now, it has nothing to do with the Australian dollar or the Canadian dollar. But there could be a ripple effect. You never know. And I think traders in general are just on the sidelines right now. So this little red candle doesn't bother me. A general technical question: how do you identify unfilled orders on a daily chart? Well, I don't think you can definitively identify unfilled orders ever, but I think there are some cases where we can make assumptions. Like, for example, gaps, right? In this case right here, right? This is a significant gap on the most liquid currency pair in the world. So I would assume that there are unfilled orders there. And one of the things that we talked about in this room at the time was the failure to fill this gap. Like it just wouldn't fill during April and early May. And we said this is a sign of strength. The fact is that there are probably unfilled orders in here. And the banks and brokers want those orders to be filled, but they cannot push it down. Therefore, if they can't push it down, it's probably going to go up. And boy, did it ever go up. right? So I would say like that's one example of identifying unfilled orders on a chart. There's more than one way to do this, but that would probably be the most obvious way. Is with gaps. That's probably the most obvious way to identify an unfilled order. But you never know for sure, Richard. And let me explain. See, you and I can cancel an order, correct? Well, if you and I can cancel an order, then certainly anybody who placed an order inside of here can also cancel it. They have, if you and I have the ability to cancel an order, so does anybody else. So it's possible. We don't know. We'll never know for certain if an order has been canceled or not. And therefore we'll never know with 100% certainty if there's an unfilled order sitting out there. But we could say, well, we know there's a good degree of, there's a high probability of an unfilled order sitting out there in this area. The more time that goes by, I think the less probability that there's an unfilled order in here. But on the other hand, an awful long time could go by and there could still be an unfilled order sitting out there. Okay, I hope that helps. In this size area too, that's like maybe 100 pip gap. And this is the most liquid currency pair in the world, Euro USD. Probably a lot of orders in there. Okay, there are probably a lot of orders in there. Ed, were you able to get in New Zealand USD at 70-60 area, NZD USD? I wanted to buy half at this area, and I think I just missed the entry. I think I had it set at I think I just missed the entry on this. I might have missed it like by the spread. Really frustrating. But I'm not in it, but I definitely wanted this on the pullback, and but I did not get it. And this is something that I was saying. I said I wanted to buy half here, so I put two green lines in. The two green lines were my entry points. I wanted half here and half here, but for some reason this did not work out. So I've been under the weather. So I haven't been paying as close of attention. So, but I believe I missed it. I may have missed it by the spread. I'm not sure what happened. Carlos says, so you missed it too. It stinks. What are you going to do? Yeah, that's the way it goes sometimes. There'll be other trades, though. I'm still basking in the dollar-yen trade, though. I didn't miss the dollar-yen trade, and that was, it's like you with your Aussie CAD trades. You hit one out of the park, and you don't mind so much that you missed a different one. But look at this thing go, right? It's already hit two targets, and it's running toward the third target. Nothing but green candles. Nothing but green. I don't see any. There's no red candles. Just nothing but green candles all the way. So, one thing for sure, we can pick them, right? We know how to pick them. And Aussie and New Zealand are just the strongest. They're the toughest kids on the block right now, right? They're the strong ones, right? But just getting back to that concept of unfilled orders, that's how do I'll tell you how I play that. I think like this. Here's how I try to think about this. I realize the price came up in here, but afterwards, well, more orders may have been placed. And here we've got 107.36 to 108.21, but the gap can't fill unless the price comes under that wick. So my entry would be under this line. So I'm trying to make this. So it has, in other words, the gap can't fill unless the price gets under that, inside those two lines, right? So the price is above those two lines now. It's gapped. The price has moved above this area. So in order for the gap to fill, the price would have to come down into this area, right? So the price would have to come under that line. So my entry is under that line. So this way, if the price never comes under that line, my entry can never get filled. My entry can never get filled. So that X, it's going to be my entry. I'll make it green. Now maybe the price comes in there. And I don't know if the entire gap is going to fill. So I'll have two targets. I think the middle of the gap is an excellent target. So I'll make my targets blue. Because there might be, we don't know where the orders are in here. We're assuming there are orders inside of this gap, but we don't know where they are. The banks and brokers don't know where all of the orders are, but they know where their customers' orders are. So Goldman Sachs knows where their customers are located, and JP Morgan knows where the JP Morgan customers are. They know where those orders are. Does that make sense? So maybe Goldman Sachs is only interested in pushing it down to a certain point, and then at that point their customers are taken care of, and they have no interest in pushing it further. So I don't know. I don't know where any of the orders are. So I think trying to bet on them to push it all the way down is a risky bet. So I'll close half the trade at the halfway point and half the trade at the far side. Of course, this is going to have to use a stop. because it's possible that the price just trickles in and then it just comes right back out of that gap. If that happens, I'll just take a small loss. If we hit the first target, I'll bring the stop down to a break even. And that way there's no risk. And we can remove the risk from the remaining part of the trade. All right, but that's how I would play this. And what's really important to me is that the gap has to be big enough to make this worthwhile. Most gaps, like the Sunday night gap that you see, the 10 pip gap on Aussie, that you see the typical Sunday night gap, it's not worth it. It's not worth it. So it's not worth your time. But a gap this size, like an 85 pip gap on Euro, that's worth pursuing. Right? Or some of those gaps we saw leading up to Brexit, that might be worth pursuing. Right? So, but that's how I would play it. Keep these spread out. Polls tend to create some big gaps, get some big weekend gaps leading up to elections. Didn't see it this time around. Saw it in the U.S. dollar Mexican peso leading up to the U.S. elections. This was leading up to the French election. So elections do seem to create some pretty big gaps, especially based on polling data as we head into the elections. In this case, the polls were correct, although that's, you know, we've certainly saw that plenty of cases where the polls were incorrect. Okay, so that's how I play that. And the assumption is that those orders could be canceled, but the assumption is that the orders are in here, and that the clients want the orders filled at those prices, and that's why the banks and the brokers. Why do the banks and brokers want to push the price into that area? Because they want to keep the clients happy. The clients want to buy. The clients don't want to buy the euro up here. They want to buy it down here. You want to keep your clients happy because you want to keep. The clients don't understand how this market works. They just want what they want. The clients want to buy euros at 107.50 or 108. They don't want to pay 110 or 111. And they think you're good if you can get it at 108, and they think you're bad if you end up paying 112. And you lose the account, and then somebody else gets the account and gets the commissions. The clients aren't that sophisticated. They don't understand that the price gapped because of an election, and they just don't get it. Right? You can try to explain it to them, and you might be able to successfully explain it to some of them. But other ones, you won't be able to explain it to them. You don't want to lose their business because these commissions are awesome. So you're going to do everything you can to try to sneak the price down there. Now, it's easier said than done. Middle of the night, first of all, the price has to be close by already. And then in the middle of the night, when the market is illiquid, you got to hit the sell button to try to push the price in here. And try to execute some orders. Maybe you get a little help from your friends, as the Beatles might say, right? And everybody hits, you know, your friend works Citibank, but they used to work at Barclays, and you keep in touch, maybe you had lunch the other day and you decided that, hey, he has some orders down there too. And maybe at 11 hours, 11 minutes, and 11 seconds, you're both going to hit the sell button simultaneously. But there's no paper trail proving this. It's just something that it's just a coincidence, right? Could happen. It could happen. And that's how it happens. Targeting 1 or 2 home runs a month, but the thing is like it happens when it happens, right? I mean, the thing is they sail over the fence when you got to take what the market gives you, right? If the market doesn't want to give you a home run, it's not going to give you one. "13 days after the price gap to make the impulsive move." Yeah, it just hung there forever, and then it took off. It was very strange. It was a very strange, but it just could not seem to drop. But anyway, that's the dynamics behind gap fills, and sort of the skullduggery that goes on behind the scenes in Wall Street and places like that. They just want to make commissions. They don't care if it's a win or a loss, and it's not even speculation. It's just somebody needs euros and they need them at a certain price, and the customer's not happy if they got to pay $1.12 for the euro. The customer wants to pay 108 for the euro, and they're just not going to be happy paying $1.12, and that's just the way it is. And you're going to lose the client, and you're going to lose the commissions. So you got to try to make the customer happy, and that's the motivation for trying to fill that gap. Okay, so you try to see it from the trading desk side of the equation. Okay, that's what they're trying to do. All right. Okay, gang, that's going to be it for today. I hope you enjoyed this, a little bit of insight sort of behind the scenes stuff and what kind of nonsense goes on behind the scenes. My name's Ed Ponsi. I'll be back with you next week. Have a wonderful day. I'll talk to you soon.